We're live. Cool. Hey, welcome everyone. We're live for Kernel's Building Smarter Kiwi Portfolios. I'm Armin. I'm the head of product at Kernel. I'm here with Dean, who I'm sure most of you know, our CEO. Tonight we are going to be covering a wee Kernel update on where we have got to for the year. We're going to do a deep dive on shares and ETFs, more of a shallow dive probably, and then cover some Kernel customer requests, and then we will finish up with a live Q&A. Just a quick one to shout out to everyone. All discussions today are general in nature and not to be taken as financial advice. The views and opinions of the speakers are their own and may not necessarily represent the views or opinions of Kernel.
And obviously, yeah, if you're investing with any of our products, look at our website. We've got all information on there. You can find our product disclosure statements at kernelwealth.co.nz. But if we're looking at a lot of the chats, it's great to see so many of you online live and ready. So we can see that coming up, which is fantastic. We may address some of these as we go, but equally, we've got plenty of time at the end left for diving into Q&A on any of the topics we cover. So do feel free to drop in your questions as we go. We'll come back to them at the end. And if we don't get to everything, hey, maybe it means we need to do this again, or feel free to email us, chat us. We're here online and are keen to help you out. So starts at 5:30. Here's a great question. No, 10 more minutes. 5:30 here in my mind.
It's definitely 5:30 on.
Yeah. Brilliant. So yeah, Armin's covered off. We're going to cover off a few sessions. So you're in control of the slides.
So yeah, Q&A at the end. So make sure you get questions ready. You might say we're lifting the lid on the financial chili bin, and cold beers are at the bottom, so you're going to have to wait a while. But we'll crack into it. So we're going to give a little update on 2025 in Kernel and where we are.
Look, so we thought we'd take this opportunity because there's been a lot of product development and there's a lot that happens behind the scenes that delivers what we're trying to achieve for you as customers and helping you manage, understand, and build your wealth and ultimately enjoy it. You know, the idea of building financial security is that actually you can go out there and have the options and choices that you desire. And to deliver that, there's a team here in Auckland that is helping support you with the platform, the products that we build. So, you know, we've been running now for 6 years, but the last 12 months in particular has been pretty significant. And so we're touching on some of these new developments in tonight's webinar. So there's over 40,000 Kiwis now have accounts with Kernel. We've gone through 3 billion of assets that we're helping manage and grow on behalf of everyday Kiwis right across the country. And that number has been growing at over 100% year on year. And so, you know, we look ahead to the next couple of years. There is a lot that we need to be doing, and our product's been expanding. The team has been actually pretty stable. We're a small team here in Auckland, but any of you follow us closely, you will have seen that we have a number of roles that are online now that are building up the team and capabilities because there is a lot in the pipeline, and we will touch on just some of those things tonight. So thank you for those who are customers and been on that journey with us. We're pretty excited about being able to, you know, support you and deliver. And again, I really want to encourage some of the Armin here who's up our product. The feedback that you guys send in does really shape our roadmap, what we're building and what we prioritize. So do keep emailing us. And yeah, Armin, keep your mic closed.
Yeah, hopefully everyone can hear me. Thank you for pulling out. Yeah, no, absolutely. We're absolutely keen to chat to customers. You guys are all helping us shape what we're doing and how it's being done. So please reach out, send emails, talk to CS, say you want to jump on a call. I'm more than happy to take feedback and hear from you. So
perfect. So a bit of an overview, I guess, what we've achieved. So we started building out a range of investment options, and we had our basic platform that existed. But now there's kind of the whole breadth, no matter what you're trying to achieve at each stage. So we've got online savings accounts. Watch this space. We've got KiwiSaver, which has been going a bit over 3 years now. We've got 27 investment options. And obviously recently this year, we launched the access to US shares and ETFs. So kind of those core pillars to help you personalize and manage your money and wealth at all stages of the journey that you're going through and for your unique investment goals. And so we'll kind of touch on how do you build that together at the end. One of the things we want to highlight, you know, particular product snapshots, what's been going on. The Kernel KiwiSaver has been really popular. And one of the things that we've been noticing with our investors is they really like just to kind of use the preset diversified funds that we have. So, you know, we have both the option to blend and mix our funds as you see fit for your personal goals, as well as predefined diversified funds. And we'll talk more how do you think about these at the end. But take the high growth fund. A lot of people ask about what is that. The high growth fund is effectively an index fund of index funds. So we set a mix of international, domestic, and then use the Kernel funds to diversify in one preset bucket. So you don't have to figure out those combinations yourself. So things like our high growth fund have been around for a while now. Our KiwiSaver is a bit over 3 years, but we're starting to build out the options in there. And what we're really pleased with, the things that we prioritize, we are facts-based, data-driven. So index investing for our equities, we keep fees low, we focus on tax efficiency. And I think the results of that have been showing as well in the outcomes for our customers. So the Morningstar reports, they're showing actually that Kernel has been consistently rated towards the top. And we've got the full breadth of performance results there. So you can see not all of our funds yet have 3 years, but they will very soon for some of those newer diversified funds.
Obviously, some of our older funds come in there with 5 years worth of performance history. So which is great.
The new one that we can see in there, people think about that spectrum, and we'll talk about the spectrum of risk profiles. So you've kind of got the Kernel Cash Plus, and then we've launched recently a conservative that sits between balanced and Cash Plus, and then high growth. So if you're anywhere on the spectrum, you can blend it to suit your own investment goals, risk profile, and objectives. If you care about things like ESG, then you'll have to customize your own portfolio, but we have components in there like NZ50 ESG and Global ESG. So, we think that we've built a really good base here for customers to personalize and manage at all stages of their life, depending on their goals. So, yeah. So where does this, I guess, the thesis and what do we do? Like, how do we think about investments? As I said, I don't think we of ourselves as an index investment provider. What we do is we're kind of a data company. We're a data and technology company, and how we operate is look at the facts. And when it comes to building things like our equity funds, we look at that data and say, well, how do we do that as efficiently as possible? So when Kernel started, our big objective was, okay, not only do we want to make the access easier, and we want to make it super intuitive for people to manage their money at all stages, we also knew that actually the investment options underneath also needed to be really good. And we needed to build more tax efficient, more fee efficient, and more flexibility for our customers. And so we looked at the data, and one of the big sources of that as to why people are thinking about index funds is the independent research produced by S&P Dow Jones, and it's called SPIVA. And this is a really interesting report, and I'm proud that actually Kernel has helped advocate for this because SPIVA is covered in major markets around the globe, but for a long time wasn't covering New Zealand because we were too small. And what it is the S&P index provider comparing all of the active funds in the market against reflective index benchmarks to go, well, how well do they stack up over time? And how consistently are they able to outperform the market? And so we kept lobbying S&P to bring SPIVA to New Zealand. And they did that about 18 months ago. And so one of the things that we've seen now is the very first report come out. And so this was a really interesting one. The latest SPIVA report came out in September, covering the year till June. And the call-out stat there was 100% of active managers in New Zealand running a global index fund from New Zealand had underperformed the index over a 10 and 15-year period. And so we've got a chart that looks at it. If you want to find any of this data, if you're really interested into diving into the world of index investing, the independent research, I encourage you to search for SPIVA. You can find all of the markets. You have to Google a little bit harder to find New Zealand. It's not on their natural homepage, but if you search SPIVA New Zealand, you will find this. It comes out every 6 months. And what they do here is bucket into these categories, active managers run out of New Zealand in each asset class. And you can see here the data. And what does the data tell us? For a global equities run out of New Zealand over 10 and 15 years, 100% had failed to beat the index. So that tells us it's really hard to outperform the market. It's really hard to pick stocks on a global basis regularly and for your whole portfolio. New Zealand, as you can see in the short term, it's a bit more 50-50, and fixed income's a bit easier. And so these are the facts. This is what we look at. This is how we help think about designing what we do for our customers and what we put in front of you in terms of the products we build and what we're offering. So I encourage you to look out and have a deep dive into SPIVA if you want to understand a bit more about the indexing world and how indexing stacks up against active management for particular asset classes.
So SPIVA stands for S&P
indices versus active. Yeah. And so when it comes to people have questions like you see our most popular funds, we thought we'd just highlight how people are thinking about investing in New Zealand and what we definitely see in New Zealand as a whole, and not just through Kernel, that most investors are typically looking at trying to diversify away from New Zealand. So a large portion of the money is going into international shares. And that's the same within your KiwiSaver. Most of your KiwiSaver will typically be invested in offshore assets. New Zealand is a small market, so we're trying to diversify away. And we see that with the popularity of the funds. Cash Plus, though, call out is very popular, but for a whole different use case. Like often we're seeing people going, I haven't yet got a plan, or I'm trying to buy a house soon. So they want somewhere a little bit more, lower risk, that they have a bit more predictability about the outcome while they make the decision.
Like people setting up emergency funds with the Cash Plus fund, which is cool. Another one which you talked about digressing away from the, and I'm going to get to it actually on the next slide, which is around our Global Next US fund.
Yeah.
We're seeing a lot of flows into that fund. So,
so we continually take feedback from our customers. What is missing? What do you want to see available that's tax efficient, fee efficient? And so about 3 months ago, we launched a couple more funds into the Kernel universe. And one was providing exposure to Australian equities. And so the Aussie 100 fund was launched, and the conservative fund as well, to help provide a balance of when you're looking at those risk profiles. The more interesting one that people have sort of questioned us on, but actually makes a lot of sense, is the World ex-US. And so the World ex-US fund is launched for a bit of a logical reason. We had a lot of customers going, we want to have a global equities exposure, but either we're a little bit concerned the fact that the US now makes up 70% of a developed equity index fund. And so how do you control for that? Is it a bit too concentrated? Equally, we saw people go, well, I've started with an S&P 500. I don't want to have to sell that, or I'm buying US stocks. How do I add to that? And so the World ex-US has been launched, and we've seen actually it's nearly $200 million from Kiwis have gone into that in literally 3 months. And they're typically using it to complement an S&P 500 or complement the direct stocks that they're purchasing. We see the comments, so maybe the secondary mic is not working. Armin, can we give a sound check?
Thank you to everyone who can't hear me.
Does that work?
Hello? No, it doesn't look like that.
Okay.
All right, very good.
We'll chuck this in the middle.
Thank you, everyone, for shouting out that you cannot hear me. That's useful. So we're done with this one. Sorry, Dean. Are you ready to move on? Yeah.
This is going to be fun now, so enjoy it. The World X, it comes as hedged and unhedged. So for that quick question, for most of our global funds, we give people full choice and control. But if you're looking at ways of how to diversify outside of the US in a simple one click, then that's the sort of fund that, why we launched that product.
Good one. All right, and to wrap up the first section, we have a bit more on plenty on what's coming, sorry. So Michael Head, I saw you there saying, can you build us an app? We absolutely have a mobile app in the plans. If you are looking at our current openings in terms of positions, we are hiring for native capability at the moment. And so that is to help us get a mobile app into market sometime in 2026. So yeah, we're listening to you. We absolutely want to build an app. We haven't felt the need up until now. But yeah, we think it's timely to do it. Can you guys hear this side as well?
Yeah, it's just Armin. It's not actually the app. It's just Armin's. He normally sits behind the camera, is working really hard on all of these customer requests. So
yeah, I'll talk directly into it. Yes, great. Thanks, Michael Head. Appreciate that. Yes to the app, or yes to me here being heard. Anyway, we're also looking to expand our tiers. So this year we launched a tiered offering. So the shares and ETF offering was the catalyst for launching tiers, but we are hoping to layer in more features and benefits into our tiered offering, which was launched in 2025. So that's also coming up. We are looking at additional markets for our shares and ETFs offering, which I'll talk a bit more about shortly, but we are interested in local markets and also global markets to expand the shares and ETF offering. That's just due to a bunch of customer feedback, wanting to get access to a broader universe. And then we're looking at interesting cash products, so ways to manage your cash more appropriately, ways to help you understand how much more you could potentially contribute to investments at Kernel, and then additional savings products with Kernel. So
you'll see some announcements on that in terms of what we're doing with our Smart Saver account in the next week or so. So keep an eye out. There's stuff coming out, news all the time.
Today as well. So,
we'll touch on that in a moment.
Very good. So we're going to jump right ahead and move on to a little shares and ETFs deep dive, or potentially shallow dive. We're going to talk a bit more about why we introduced them, and then how they fit into the broader vision for Kernel, what's available today and what's coming. The goal is to simply give you more clarity about why we launched shares and ETFs, and how they fit into building better portfolios. So over the past 5 to 6 years, we've had a bunch of feedback. So since we launched, around a direct offering, and for some, and we have had feedback, offering shares and ETFs has been a little bit jarring. That's because we've come from our index fund background, which has made us famous. But when we did survey customers in 2024 to understand about whether or not they were using direct, we found that a lot of our loyal customers at Kernel actually had direct investments elsewhere. Still getting some mic feedback. Okay, sorry. Hopefully, just keep shouting out. I appreciate the feedback. It's great. Customer feedback on the fly. But we found that more than 40% of our customers were already investing in shares and ETFs on other platforms. And those numbers were considerably more when we asked customers about whether they intended to invest in shares and ETFs. And so we also know that customers want a single place to manage their wealth. And so for us, it made sense to introduce a shares and ETF offering into our product suite. In fact, we've never been against direct investing. We've long advocated for the popular core satellite investment approach, which we'll talk a bit more about later on. And so adding shares and ETFs for us was really a matter of when rather than if. It fits naturally into our vision, which is about building a central operating system for Kiwis to manage their wealth. And while expanding our product set and broadening the universe of investments that you can access through, great feedback, access through Kernel. Additionally, it ties back to our name. And so some of you may have gotten onto this, some might not have, but a kernel is the core or heart of something. It's a system or the central most important place that we're trying to build wealth. And I think that's what we're trying to build for Kiwis in New Zealand. We're trying to build the heart of, or the core system that people can manage wealth through. So direct investing isn't a departure from what we stand for. It's perhaps something we think is actually really complementary to the overall offering. All right, so we launched shares and ETFs to public around June, starting out with a limited universe of around 800 assets. So that was the US 500 to kick it off, and about 300 ETFs. And that's from some of the reputable providers, Vanguard, Invesco, and State Street. The universe to begin with was throttled as we kind of worked through corporate actions, payment flows, and various bits and pieces. But since then, we have added a bunch more assets. So as of last week, there's now 3,000 assets available on platform. So that's expanded to essentially everything that has greater than $1 billion market cap. So that's all US assets. The ETF range is also growing. So we're looking to introduce Global X, ARC, and iShares, which will increase that total ETF list by about 300. I think iShares has a bunch of ETFs, so we've turned on the full list there for them as well. Additional to that, we have added, post the June launch, we got a bunch of feedback. The offering was somewhat, I'm not going to say simple, but it was an MVP. It was light. We got a lot of positive feedback actually by launching the product, but it was, I wouldn't say it was feature rich. And so we have added a bunch of new features such as limit orders, watch lists. We've increased the performance history on all the assets and also the performance history of your investments. So these features are now live. And I can also share that these features are now live for all customers across all tiers. So when we did launch it, it was for our plus and premium tiers only. these are now available for all core tier members. So, which is cool.
I'll probably give a big shout out to our team here, and again, the feedback from you guys of like, yeah, we wanted to start with something, get it to market, get your feedback. And as Armin has touched on, we'll look to expand. We're engaging to look at what other market opportunities, feature requests, and the big thing, obviously, Armin talked on, which was building an app. So please really encourage, the more feedback you get now, the more it can feed into the design of what we're going to release in the new year, because there is a lot coming. But a shout out to Armin and our whole Kernel team here, actually. Just for context, if you're looking and wondering, how big we are, we're about 25 staff. So we're a pretty small, lean, punchy team here in Auckland that's been delivering for our customers. And, it's pretty impressive to see what we've added in terms of those feature sets literally in the past few months, while we're also doing this other work simultaneously. So yeah, keep an eye on it and keep the feedback coming in, because it helps make our list of priorities much easier, and make sure we're delivering what you guys need.
Yeah, totally. And I mean, there is a lot of stuff happening globally that's really interesting and applies to the shares and ETFs offering. Like, we look at global markets, but also things like 24/5. So you got 5 days a week, 24-hour access. These types of things are all things that we're looking at, we're interested in. We'd love to hear if these are things that you guys are interested in. That just helps us understand or get a pulse check on what's important and how we prioritize internally. I thought I would drop in a 3-month snapshot of the top 10 shares and ETFs by volume. And so you can see here some of the big names, but also some interesting ETFs. No surprises that VU is number one. I think that's pretty consistent with most trading platforms in New Zealand. But also there's a gold ETF there, which is interesting. And then, some of the big names further down the list. But hopefully a snapshot. I know people are curious on what others are investing in. And so, take that for what it is. Finally, I wanted a chance to talk a bit more about tiers and fees. I was about to say tiers and ETFs. But alongside shares and ETFs, we did launch this year our tiers, our tiered offering, and then also our staggered fee model for shares and ETFs. And so shares and ETFs was the catalyst for launching tiers, but it wasn't the sole reason that we launched tiers. We hope to layer in a bunch more features and value and benefits into our tiered offering. The first piece that has been layered into that tiered offering is FX. That we apply to shares and ETFs. So on our core plan, it's 1.5%. And if you then go into our plus plan, you'll get 0.6% FX on your trade. And then if you go to premium, it is 0.4. So we've got a staggered FX rate there that applies to your tiers. To calculate this, we have actually a really neat, and I'm not sure if, I hope everyone's seen it, but if you haven't, I'm going to shout out about it. We have this awesome little calculator on the marketing website, on the shares and ETFs page, which helps you understand which tier might be beneficial for you, and also compares it to some other well-known providers in New Zealand. It is really hard to understand based on your behaviors and use cases, like where you might invest in, like what this might cost you. And so if you go to a marketing site and plug in what you hope to invest into the US market per trade, you can get a good snapshot. We're trying to make this as transparent as possible. There's obviously some caveats and things in there, like premium discounts. There's also auto invest discounts that other providers offer. So read the disclaimer and just make sure that you understand how it works before you make any decisions. But that tool there is handy. You better use it. But we have a bunch more feature development in the pipeline, which will, some of it will be layered into these tiers. And as a rule of thumb, we're hoping to give Plus and Premium tiers access to these features ahead of others, because we know that they're committed to the shares and ETFs offering. But that's not to say that they won't trickle down like our other features that we've just rolled out to the full broad spectrum of the tiered offering. So we have some exciting stuff planned for the UX of the platform as well, which will layer into these tiers. That's all coming into play kind of Christmas time, us doing a bit of a dashboard overhaul alongside a bunch of other exciting features that we have in the pipeline. So,
Can the question there, where do we get feedback? Armin, how do you love to get feedback?
Well, I'll do the thing. Look, send it to me directly. It's armin@kernelwealth.co.nz. I'll take it. Send it straight to my inbox. I'll absolutely hear about it.
I saw the little check to see how many were live and going, what have I just opened myself up to here?
I'm all about it. Send it through. Or customer support. So we have support at Kernel Wealth. You can always send your feedback through there. We use customer success as a really strategic asset here at Kernel. The product team talks to them closely. And so if stuff is talked about with them, it's generally shared with us in products. So please share broadly any feedback. Come to me direct. You have my email now. I'm more than happy to hear about it.
Yeah.
And yeah, let's jump on a call and chat about it as well. Won't give my phone number out though.
Yeah, look, big or small, do send it through. Like I said, keep an eye out. There's going to be a bit of an overhaul with the dashboard. That's going to give us a lot of great feedback and insights before the app starts to get finalized and all the other features that come through. David, you shouted out there, if you're just investing in things like Kernel's Pi or KiwiSaver, for example, no, don't need to upgrade your plans. You can do that through the core. That's perfectly accessible. You don't need to pay any additional fees. Over time, as Armin said, you'll start to see a lot more value about what we're delivering. And at that point, that may be the time that you want to upgrade. And you can manage that as an investor through the platform, upgrade, downgrade your subscription as you see fit. It's all just online. So you choose the moment when that's right, but you do not need to do that now if you just want to use the kernel funds.
Yeah, great. Keep the comments coming in about shares and ETFs. I'm happy to answer any more of those at the end of today's prezo, but we're going to move right along. That's all for shares and ETFs now. Into some of the common requests or customer requests. We did send out a survey beforehand to get some feedback on what you wanted to hear about tonight. Portfolio mix, tax, and crypto were the ones that popped up. And so we will talk about those right now. Perhaps we'll jump into the crypto question right there. I don't think we've actually got a slide related to crypto, but Dean, perhaps do you want to give your view on Kernel and crypto?
Yeah, look, I think what we're finding interesting is the digital asset space is evolving really quickly, and there's a few things going on. One, I think we've obviously now got that ability to have that as a satellite through the shares and ETF feature, and you saw that was one of the top 10 holdings. Most people are still just centering on the well-known Bitcoin. I think our biggest challenge has been, okay, not necessarily how does this potentially fit within a portfolio, but how do we add value to it? And I think at the moment, there's a lot of great places where people maybe have a preference for how they want to structure and hold it, like a wallet. But then there's also the tax considerations. One of the challenges of New Zealand investors is that you've got to pay capital gains tax on your crypto. And so, I think they need to be solved and considered first. So look, we never rule anything out at Kernel. It's all about helping understand the role that things play and aligning to our value proposition. We're not trying to build a trading platform. We're trying to build great habits that achieve good financial outcomes for Kiwis so that they can then go and enjoy their assets and their wealth, how they see fit with their life, right? And so we will either look to support that in many different means. So nothing on the immediate roadmap at all, but you obviously can access it through a crypto ETF through the shares and ETFs function. So
yeah, very good. Cool. And so the other pieces that we're going to chat through are how to set the right portfolio mix and then how to optimize for tax and efficiencies. So moving on.
Look, so I thought maybe I'd just sort of take a moment to step back before we go into portfolio mixing and talk a little bit high level about what's going on. And again, if you've got more deeper dive questions, we can jump into this. But there are kind of these four big themes that sort of people keen to be talking about, or at least the media likes to talk about. Probably the most substantial political situation that's on the go, and politics does feed into markets. We've seen that in 2025. We had a lot of volatility when tariffs got announced. We've seen rebounds. So political decisions do impact our economy, do impact financial markets. The stock market is not necessarily reflective of where things are today, though. They are looking ahead. And so I think while the economy maybe has been struggling in New Zealand, for example, share markets have been ticking up, the same in the US. So there is a disconnect there and the timing difference between those two. But two big things to watch in 2026 is the New Zealand election coming up, which 3 years gone by in a flash, but also US midterm elections. So that is probably the big global markets key point to watch. We've seen a couple of early election races coming through. Everyone's going to be getting a sense of, well, how much constraint may come on the Trump administration, the US post-US midterm election, and are they going to lose a bit more of the control and flexibility they have, and therefore that the end of the policy changes. Now, New Zealand election is probably going to be much more interesting for us. The reason I say that, we saw the announcement last week on National's KiwiSaver policy. Most things that we're seeing and hearing, 2026 is likely going to be a big election talking point is going to be KiwiSaver and superannuation. Expect to see every major party coming to the election with their proposals. National has come out with a proposal to increase KiwiSaver contributions to a combined 12%, matching the Australian market. But I think we're going to see a few more twists to come. And one of those is the conversation around superannuation access age. We have an affordability challenge over the long term on this, and the trade-offs we want to make. I think that one of the proposals, and something I'm actually personally advocating for, is that I think Kiwis will buy into an increase of the superannuation age to 67 if they decouple KiwiSaver access. And so if KiwiSaver could be accessed at 60 rather than 65, then maybe that gives people flexibility to manage their own life stage and situation. If you're working in hard labor, you're much more likely to need to retire early. How do you get access to that? So that's more common in overseas markets. In New Zealand, just for those that aren't aware, KiwiSaver access age and superannuation age are actually tied together. So they need to break that from a legislation point of view. So this is a chance, if you're conscious of fifth tax, which I know a lot of our followers are, if you're conscious of KiwiSaver and contributions, do get out there and make sure you're advocating for it when you engage with your political parties or local candidates, because I think next year we're going to see a lot of conversation around superannuation and KiwiSaver. And we'll be out there drumming up ideas as well about how do we make it more effective to help people whether self-employed, kids, or others. Interest rates, topical for today because we've just seen the OCR get cut by another 0.25%, so down to 2.25%, and signaling that actually inflation looks really under control. And so next year there may still be further cut or two to come. We have Christian Hawkesby is stepping down now, and we've got the new governor coming in. She's an observer at the moment and will take control for the next OCR decision. I think we want to see where that plays out, but what that means for mortgage holders is great. Interest rates have been coming down, so mortgage rates have been coming down. But if you are saving or you've got short-term investments, then what you earn on those is going to fall. And then you've got to consider, well, what tax have you got out of that as well? And then what inflation? Surprisingly, though, term deposits in New Zealand are still at record highs. There's $144 billion sitting in term deposits by mum and dad investors in New Zealand today. On top of that, there's about $80 billion in on-call savings accounts. The on-call savings accounts tend to come down earlier. That's because they're much more accessible and their rate changes almost instantaneously. And then people start to look to move that around. Term deposits start to come down later as a lag because they're locked in. And as they roll off and go, oh, I used to earn 5% of my term deposit, I can now only get 3%. That doesn't really stack up for me anymore to meet my income needs. Now that ties into another big problem, which is the housing market. So people who have historically looked for income, they may have invested in investment properties, but that's also not working. And so you've had a flat housing market for 3 years now. And what you're seeing there is also a lot of unsold inventory, where resales are actually selling for less than the purchase price. And that's a reflection of these prices have been falling. And so people are selling and they're taking a loss on that. I don't think they are necessarily financially strained for a lot of that. We're not seeing any real stress in the market. People are, I think, accepting the fall in value and going, well, we're going to buy again in the same market. I'm happy to switch. I'm going to take the hit. That's fine. I'm buying the same. We're not seeing those sort of losses occurring because people are not able to meet their mortgages because mortgage rates have been coming down as well. So I think as a whole, New Zealand economy is looking fairly strong at the moment and setting up okay. There's definitely a lot of patches. You combine those things, though, and the last piece there is this sort of talk about AI bubble and the growth. And we've got things like NVIDIA, which has become, at one point, there was the highest single stock concentration in the US market in history. You've got the top 5 names making up a really large concentration, 30, 40% now. You've got the US share market making up 70% of global index fund, global benchmarks. And so people start to look at all of this together and go, well, there's a lot happening in the headlines. There's a lot happening in the world. What am I meant to do? And, housing's flat. I'm not getting anything on interest rates. Should I be concerned about investing in stocks? And they get into paralysis. And I think they just go, oh, I don't know what to do. So they probably do just sit in an on-call account for a while. But I think the reminder here is to look through some of this. The concerns around this AI bubble are not the same as what they were with things like .com. There is genuine earnings growth. There is genuine investment growth here. I think there is a lot of new pop-ups that are interesting to watch. Like what we talk about with our business where we're leveraging AI. I don't think it's the big companies that you're seeing on the exchange. I think what's going to be interesting to watch is all of these new AI startups who have got like sovereign wealth money, and all of a sudden in about 3 months they're worth over $1 billion.
Totally.
And they've had massive ARR growth. Now, that's been quite easy to achieve, but what's the sustainability of some of those revenues, and what stops somebody else just copying? I think that's a big call out. So one of the things as an investor is we'll try and tune out this noise and set up a portfolio that meets your goals and align that to what you're trying to achieve, and not worry about these headlines. So when you're thinking about that, we don't need to talk about housing, I think, anymore. If you've got questions on housing, I can come back to it. I think my 2 cents on the housing market is, one, while the housing market is down, I think we've now finally and hopefully broken the back in terms of Kiwi's obsession with property in New Zealand. And flat housing market is actually really good for us in the long term. We may not like it in the short term, but it means we start to invest elsewhere into companies and growing jobs. So it's a really good outcome for New Zealand, I think, in the long term. You compare that right now, by the way, if anybody's looked at Sydney, they have got absolute housing shortage and boom in terms of valuation, but rentals are going through the roof and you cannot get a property. That's a much worse scenario than what we have in New Zealand. So if you're thinking about job opportunities and long-term wealth, please don't jump the ditch. Stay in New Zealand. We're hiring at the moment, so look out for our job adverts if that suits.
Shout out to any native app developers if you're interested.
Yeah,
check out the openings page on careers.kernel.co.nz.
Yeah, so interesting space. So quick portfolio mix. I talked a little bit about this earlier, but it's this real simple idea, and this is more common. We see this quite often with KiwiSaver. Within KiwiSaver, you typically have had these 5 risk profiles. Those sort of common risk profiles that people talk to. And effectively what it is there's a different band of how much goes into growth assets like shares versus the blue being sort of income. So that's cash, term deposits, fixed income, bonds, etc. Now, these bands, by the way, they are preset and defined. So if you want to be a high growth fund, and if you want to fit within sorted.co.nz or .org.nz, some of those screens, you have to be within that category. So, Kernel has a high growth. We've got a balanced conservative and kind of got the cash plus. We don't have a growth. So these are tools to align. Like if you're investing for the long term, you don't need to worry about those headlines. If it's your KiwiSaver and you're not going to access it for 10, 20, 30 years, you've got time on your side to ride any ups and downs. And so something like a high growth fund, that's highly diversified. It's invested across New Zealand, global markets, thousands of stocks, different sectors, different countries. And you can ride through the volatility. You're contributing to it regularly. And as you get closer to that, you can start to then think about, do you want to bucket it? Maybe you want to put some money that you're going to intend to spend within the first few years of retirement in a cash fund, because when you reach 65, you're going to go, actually, for the next 2 or 3 years, we want to use that amount. Then we want to put some money into the balance because we're not going to touch that still for 7, 8 years. And then you want to keep some in high growth. One of the things I think people get wrong, particularly when it comes to retirement and thinking about this portfolio mix, is that as they get closer to retirement, they move their KiwiSaver from high growth right down to cash. Now, the problem with that is it's not like you get to 65 and are going to spend all of that money in the very first year. You potentially have 30 years, 30, 40% of us now are going to live well into our 90s. So that's 30 years of retirement to fund. And superannuation is not giving you a lot of choice. So you still need some assets invested in shares that you want to touch down the line. So yeah, I think a good call out there in terms of just thinking about how do you blend those strategies. Now, that's a nice, easy way to do that. If you don't want to pick and mix your own funds, you can think about the diversified funds and then you can bucket it. Of course, with Kernel, you've got the full flexibility to blend between any of our fund mix to create your own portfolios. And so what Armin and I touched on earlier was this idea of core satellite. And so you can build a core portfolio using well-diversified, low fees, tax-efficient index funds. And you can customize that to suit your own potential flavors and needs, be it you want to be ESG invested, be it you want to be only in global shares. And then alongside that, you can buy your direct stocks and mix it up as you see fit. So core satellite investing is something we're being a big advocate for. It's saying that don't bet your whole wealth or whole portfolio on one single stock or one single strategy. The core is going to give you the diversification and pathway you need to get to the goal. And the satellites are the things that are more engaging, that may accelerate your returns, maybe more personal interests, but you're not betting it all on one single thing. Thought a little bit tax, like tax is a key thing, and one of the things that we looked to solve from day one, by the way. We were very conscious of optimizing for tax, and we did that when we were small and innovative. And I think Kernel is demonstrating a history of actually being a market leader when it comes to building better solutions, building a better platform, and doing that as efficiently as possible. There's a couple of things to think about with funds, and so we've obviously got now the shares and ETFs. That's tax at your personal resident withholding tax rate. So just for people to understand, the resident withholding tax rate is basically the tax rate, the marginal tax rate that you would have as your personal tax rate. So you can see there, that goes up to 39%. And things like trusts now are also 39%. And so this was a simple example of what would it look like comparing paying tax if you were taxed on your resident withholding tax versus your PIR, which is the rate that's set under a pie structure. So when you invest into a pie structured fund, like your KiwiSaver or the Kernel funds, that tax is capped at 28%. And so you can see as you go onto a higher tax rate, you start to have those savings versus what you would get if you were buying a stock directly or a fund directly and managing your portfolio. So pies generally at a high level have a lot of benefit because it caps that tax, particularly on somebody who's on 39%. Couple of call outs here though, because there are actually a couple of types of pies in New Zealand. One, which is the Kernel structure, is a multi-rate pie. The other is a listed pie. And so multi-rate pies, like Kernels, will tax you at your actual PIR. So if you're lower income or retired and don't have much income anymore, or a kid, for example, you could be taxed at 10.5% or 17.5% up to 28%. Whereas a listed pie, so that means ETFs, exchange traded funds listed on the New Zealand stock market, they're actually taxed at a fixed 28%. So you have to then go and recalculate and get a credit. It's a big call out here. So if your PIR rate is lower, something like Kernel's multi-rate pies are much more efficient at the way they handle the taxation. You don't have to claim back credits. And if you're a child, well, you don't have taxable income. So there is a whole lot of stuff around that to think about the difference between using a New Zealand ETF at 28% versus unlisted funds like Kernel where they're a multi-rate. So just a distinction that there are two types of pies in the market. The other big one that a lot of investors talk about is fifth tax. And this is something that even the creator of fifth tax actually came out, I think, yesterday and was apologizing because this was designed about 30 years ago and has not been looked at since. They are looking at it at the moment for migrant investors who come here and own offshore, but not for local investors. So when you are taxed on your investments, tax is a cost that you want to consider, just like management fees, just like transaction fees, just like brokerage fees and FX. It's not the only thing that you should make your decision on, but as a whole and collectively, these things all contribute. And so there are a couple of layers to fifth tax, and it becomes quite complicated. So just work through me, and we're going to recommend you a guide. I'll step back and go, what is the first thing? One is withholding tax. So before we get to fifth tax, if you buy offshore shares, be it in Europe or US or wherever it may be, those companies may pay a dividend. And in a lot of markets, those countries will have a withholding tax. So in the US, if a company pays a dividend, there is a 30% withholding tax. So say they paid 2%, 0.6 would be held back with the withholding tax. New Zealand has a lot of treaty arrangements where for a lot of these developed markets, we can file and claim back a credit for half of that tax. It varies, but so say the US, while they withhold 30%, we can claim a credit for half of that being 15%. And we can use that to lower the tax that you as an investor will pay in New Zealand. Now, obviously, what does that mean? That means like if you're an individual investor, that's a lot of paperwork if you're buying stocks in every single market to try and file and do all of that. With the Kernel funds, because we're buying those shares, like our World XUS or Global ESG, we're buying all those shares in every market. That means we're able to work to process and get those credits back to lower your New Zealand tax bill. If it is a fund in New Zealand or you're buying directly a fund overseas that then owns stocks, you are not able to get those credits fully back. So it kind of breaks the chain. So that's something to be conscious of. So if you're using a New Zealand PI fund that's just wrapping up an offshore fund, like a Vanguard fund, you're not going to get all of those credits back because there's a break in the chain. And so there's this hidden tax cost. So this is tax leakage that people talk about. This is what we sold from day one, and we've always been buying and wrapping up directly to claim those tax back. So withholding tax is one thing. Fifth tax, there is two methods, and we'll put those on the right, the fair dividend rate and the comparative value. PI funds in New Zealand, they are all the same. We don't get a choice, unfortunately. That means we always have to use the fair dividend rate. It basically means that for the global shares, you're always paying tax on 5% of the average portfolio at your PIR rate. But we obviously try and claim those credits to make your tax bill as low as possible. So the beauty of PI, it's all taken care of. You don't have to do any paperwork. Just for clarity, we also get a lot of questions because Kernel's PI funds are calculating fifth tax. It doesn't count towards your own fifth tax. So the last thing I want to talk about tax is what about this up to $50,000 that you can invest? Correct that you can have a cost base of individual up to $50,000 where you buy an offshore share or an ETF. And rather than have to calculate this fifth tax, fair dividend or comparative value, you'll only pay tax on the dividends that you receive. And that's called de minimis. And so why we think also the shares and ETFs function is really popular is that we see a lot of customers going, great, I'm going to buy $49,000 of Vanguard S&P 500 or Total World directly because I'm only going to pay tax on the dividends and I can have low fees and I don't need the pie structure. And then when they get above that, they go, I actually now want to start using some pie funds. So tax is complicated. It's very personal. We don't give tax advice, but that's some context to how these different things work. And I think now with Kernel as a platform, it's giving today a lot of flexibility in terms of how do you optimize and minimize your tax. And I think I will do a shout out that from day one, we've always tried to make sure that we're doing it as efficiently as possible because tax is just like any other cost. And what Kernel is trying to do is deliver the most efficient, greatest value for our customers. So
totally, and I'll echo that. We do see the behaviors of customers coming in and dropping 49K in and then shifting to things like our PI funds. But additionally, those customers that do have over 50K, you can download reports and statements and all the things via the shares and ETFs offering, so you can calculate. You can
calculate your own tax. Yeah. So don't let tax just be our only decision maker, but I think it's have a bit of comfort that we're trying to make them as efficient as possible. Now, for those that do like to dive in a bit more technical on this, because there are a lot of elements in consideration, and that's kind of trying to condense down 100 pages of IRD fifth tax into a couple of minutes. We have produced a tax guide, and so I think this is available on our website somewhere. It may not be the most obvious, but we can share the link. This gives a bit of a high-level overview of fifth tax and tax on global equity. So if you want to dive deeper into it, if you want to understand a bit more about the trade-offs and considerations between buying a US ETF or a fund in Australia or direct stock, then this is the guide for you. And you'll probably want to read it about 2 or 3 times before eventually maybe it starts to sink in. But hopefully it gives you some background for those that like to dive into technical tax.
There you go. Lesson in tax, and from no one more qualified, Kernel CEO Dean. We're going to jump right ahead to the Q&A now. So please fire through some questions. I'm going to jump to one that popped up earlier, which was, how can I get my kids started with investing? I can't remember the handle that sent that one through, but you absolutely can get your kids started investing with Kernel. If you head on over to our sign up page, there will be the ability to select a kids account, and then it'll ask you for a few things that you need to supply us in order to open those accounts. And then we do have a neat feature where we can link you as an individual to kids accounts. And so, yeah, this is all available. So yeah,
I think the call out there is like, we know this is just scratching the surface. Do think of this as still a bit MVP, but there is a lot that we want to do around how you link those accounts. Kids Kiwi Saver, not yet really available. We are really conscious of it. We know a lot of people saying, can we have a Kids Kiwi Saver where we've got no minimums or anything else? Yep. On our radar, we understand that we've just got to work through more administrative processes to make it super efficient for our team and make sure that it's a great experience for you guys. And so we'll get there with that. It's on our radar. So again, hear that feedback loud and clear.
Yeah, cool. And for your call out, there was another customer that followed on them, hopefully a customer or potentially a question around how those accounts are linked together. I think it was someone who wanted to see their husbands or wives or whatever, vice versa account. We can't currently link individual to individual accounts, but yeah, as Dean says, we have stuff in the works to make multi-account a feature that would enable this type of stuff. It's a work in progress at the moment. It's an individual to child account linking relationship, but we have exciting stuff in the works here.
A couple of questions, and it's sort of looking up here, but also on a platform, why is the high growth fund so New Zealand bias? When high growth fund is typically used by KiwiSaver investors, and when they are looking long term, and it's typically going to be their second biggest asset, there are tax benefits to investing in New Zealand. New Zealand is one of the unique regimes where you get imputation credits that lowers the effective tax on the income you have, and we don't have capital gains tax here in a PI fund. I should caveat, there is potentially capital gains tax if you're a trader, but not within a PI fund. So you'll typically find most KiwiSavers are overweight to New Zealand versus what they represent in the share market. And that's driven actually by the fact that there are tax benefits and diversification needs still. And don't rule out the fact that New Zealand actually, for quite a long period of time, till about maybe 3-4 years ago, New Zealand was actually the number one performing equity market for 10 years, outperformed the US. So we can't predict which stock market is going to do best when. It's about being diversified across countries and trying to keep it as optimized as possible. And we look at these things, just by the way, we do reset them, we adjust it to make sure, but not major, we keep them on tune. And I think what we've been excited by, if you look at the Morningstar results, for example, I think the fees, tax, and making sure that it's very vanilla does stand out.
One there that I'm going to jump on, which is, can we make shares and ETFs available to joint accounts? There's unfortunately a hard limitation on this one due to our agreement with our US broker dealer and FINRA and SEC guidelines and stuff. We can't do this. So it's an individual account feature for now, though there is some scope for companies and entities down the line. But yeah, joint accounts is off the cards at current. I think there was another one there that I'll jump on, which was, can we customize our KiwiSaver across funds, even if one provider? But yeah, at Kernel, you absolutely can do this. So we've been self-directed from day one. If you go to our KiwiSaver flow, there is a customize plan step in that flow, and you can customize across our 27 funds. So you can pick and choose whichever funds and have an allocation or a percentage allocation to any one of those funds if you desire.
Cameron, are there ETFs? Yeah, there are ETFs in the New Zealand share market. I know them well, I used to work there. But the main call out, as I said, are listed pies. So just consider tax and fees when you're looking at these, and whether there's tax leakage as well. So Kernel funds, while you can't trade them during the day, does mean there's no brokerage. It does mean that you can buy fractional really easily, and you have real optimized performance outcomes through better fees and taxes. Wondering if there's a way to move into Kernel, ACATS transfer, share transfers. Again, that's just a waiting on some of the limitations with our broker, but it is, again, being looked at and tested. So we've done a few previously in testing. It's just totally automation of it.
Yeah, so there is manual ways to do this right now. So if you're interested, please contact the support team. We do have some work in progress making this a whole lot more seamless.
So that way you can transfer other assets into the Kernel platform. Yeah,
that's right. Will you make an in-app way to make KiwiSaver contributions? This is an operational thing. We've had this request a few times, and so at current, yes, you're right. You need to make the transfer from your bank or via IRD. We're looking at how you could make a transfer in-app. Keep your eyes peeled.
Joy, how do we know the difference between Kernel funds, actively managed, exchange traded, mutual? Great question, just for technical design here. So all the Kernel funds are unlisted, so they're not, otherwise they come by different names, unit trust, etc. They're not exchange traded. So the Kernel funds are bought directly. That means they're not listed on a stock market. Again, we did that because while you lose the ability to trade it during the day, we didn't like the tax design and the higher fees associated with being listed on the stock market. We felt our design was better for long-term investors who wanted to regularly invest. Our equity options are all index tracking, but our NZ bond and NZ cash is actively managed. And that feeds back to some of that SPIVA data we talked about. What does the data tell us? Where do we add best value?
Yeah, cool. Why the return is always 2 days delay? This is because T+2 settlement. It takes us some time to have unit pricing come through and settle trades across the world. So everything generally runs on a T+2 settlement, though this actually is changing globally. It's generally getting a bit smaller. So
we won't touch on that today, but there is a lot that's changing in the world, and I think the pace and change of what's going on is evolving really quickly. Sarah, maybe it is Kernel S&P 500 invests in Vanguard. Actually, we invest directly. So the Kernel S&P 500 doesn't invest in the Vanguard ETF anymore. We replicate it by buying all those 500 stocks directly. So yeah, that's cool.
Switching is coming soon. How soon? That one there is actually in the pipeline for early next year. So there's a piece we need to work through, whether it leaves the market and sits in the wallet and then gets redistributed to another fund. Obviously, we don't want to be out of the market. So there's a two-part piece in progress for that one. But yeah, that one's coming. It should be at least the first part of it, beginning of next year.
Cool. Here's some questions. What's the difference between, say, Kernel, Simplicity, Superlife? Look, I think Kernel really we're positioning as a whole platform experience. Armin opened with it. We are a platform that's here to help investors at all life stages and journey that they're on. So how you're building and managing your money, how you want to withdraw and access it, be it from savings accounts to optimizing for tax, for personalizing, that's where we're going to add a lot of value. And there's, as Armin's alluding to, a lot that we're really conscious of and we're trying to build for. And so we're very excited actually about what's coming up. And so we'll deliver the most efficient solution for Kiwis to manage and grow their wealth. When it comes to things like our Kiwi Saver and a high growth fund is a good example, that is a pure index option. We're not going to look at changing those. So I think one of the questions we often get is, will Kernel start to change that mix? Well, maybe just the weights, but we're not going to do things like start adding in private equity or other assets to those funds. We've told you what they are. That's what they'll remain. We may launch additional products, but from day one what you're buying into. And that transparency is really important to us in terms of fees, tax, and what you're investing into. And so at any point in time, by the way, if you want to go onto our website, you can see all of the underlying stock holdings in any fund, including the high growth. Also within the app, if you blend a couple of funds, you can actually see in the insights function how those funds have come together and what your combined individual stock mix is. So really focused on giving transparent transparent insights in terms of what you're investing into at any point in time. So for us, I think the differentiator is very much around fees, efficiency, and those insights that we're going to provide.
Jay Kill just calling out your one to if I rebalance on Hatch, I'll trigger fifth because it goes into a money market fund instead of cash. That's right. At Kernel, it's not a money market fund. If you sell down, it comes into cash. So maybe an ACATS transfer is for you. Don't know. Come chat to the team.
Can you look at developing a feature to help auto allocate new wallet funds towards set core strategies? We have auto invest now. Do you want to talk about how that's always going to evolve?
Say that again.
Can you look at developing a feature to help auto allocate new wallet funds towards set core strategies? So you can create an auto invest today. Do you want to talk about how auto invest works?
Yeah, absolutely. I mean, we do have auto invest as a feature in the platform. So the same as I was describing for the Kiwi Saver, being able to customize your selection of funds. You can customize the selection of funds that you use in our Invest product. So you can set up a portfolio, which is a mixture of our funds, and that might be your core portfolio. You absolutely can set that up. And then you can allocate a dollar amount that you want to invest into these funds. That's set up on various frequencies. So you can pick a weekly frequency, fortnightly, monthly, and then a total amount that you wish to allocate on a regular cadence.
Right. So there's a lot of questions, which is fantastic. So is there a plan to offer not tiered management fees, but I will call out, people talk about our fees. We've lowered fees actually a couple of times now. And so, as we continue to grow, the faster we grow, the more we grow, the more options we have and how we deliver more value. As you've seen, Kernel Funds is just one element that we're offering, but our scale is helping. And so, Kernel is building a lot of scale now and enables us to do more things. And at the moment, we're really focused on building out the features that are going to help you in the short term, automate and manage and grow your wealth. And the more we do that, the better value we can deliver for you guys. And so tiers is just one element, and you'll see a lot of technology features and platform benefits come through, as well as that being reflected in what we do with the management fees of our funds.
And there's a comment there about an 80-20 growth fund. I won't speak to the fund itself, but I'll go back to auto invest. You can use a combination of our funds to effectively create your own growth fund, using 80-20 across our conservative funds, our high growth fund, if you like. So, yeah.
Is the savings account with you pie rated? No, the on-call savings account that we have at the moment is not pie structured. Again, most of these things are like, you just need to be on our mailing list. You know, it's just, there'll be a lot of updates that keep coming out. We have a busy pipeline of things in the works through 2026. So, yeah.
To the one for the high growth fund performance, do you measure the performance based on current allocation backdated? So generally where there's a performance number, there's an as at date. And so that as at date will be what the fund allocation was. So yeah, look out for the as at date and you can figure that one out.
I think maybe the question is, just so I'm clear, do you measure the performance based on the current allocation backdated? No, the performance, well, the performance that you see is reflective of the combination over time. And same with your own, it's reflective of the change in the unit price over each individual day. And obviously the markets will be forces in there as well, and also the combination. So yeah, it's a reflection of the change in unit price.
Yeah. Is the savings account pie rated?
Just covered that one. As I said,
sorry,
yeah. Cool.
Of course, sorry.
Hedge versus unhedged. So a few people have asked that. Okay, great. So when you look at a lot of our funds, when it comes to like the global share funds, for example, like Global 100, we have a NZ dollar hedged and an unhedged version. So what does that mean? Effectively, the unhedged version means that the fund is going to be exposed to the change in performance of the underlying shares, but also any change in currency. And so depending on what happens between the New Zealand dollar and US dollar, European dollar, Euro and NZ dollar, you know, that also impacts your performance here in New Zealand, positive or negative. It can go multiple ways, right? With the hedged version, effectively what that's doing is taking these contracts out to try and remove out the fluctuations in performance caused by changes in the currency. So the fund is more just trying to give a New Zealand investor the results of the change in the underlying share price. And so there are pros and cons to both of these. You know, bluntly, when we look around the market and what maybe financial advisors or what KiwiSaver funds do, a lot of them will tend to just be 50-50. What's interesting historically is that actually from a New Zealand investor perspective, a lot of the time we saw this through COVID, unhedged funds, you know, where they are exposed to the currency, tend to be less volatile. And the reason being is that when you're investing internationally, a lot of that exposure is typically in the US. And when then there is a shock like a GFC or COVID, a lot of people flight towards buying US. And so the change in currency during that moment is actually favorable for New Zealand investors. So it kind of is offsetted or reduced some of that underlying share market decline. Now, at the moment, the New Zealand dollar is sitting at 56 cents. So it's sort of fallen from, you know, $1.76 down to 56. So that's been a tailwind. So unhedged has actually had a tailwind, is why some people have noted unhedged has done better in the near term. Doesn't mean it'll be like that going forward. It's very hard to predict what currency is going to do. It's not a game that we like to play in or that many actually are very good at playing it. And so you can choose one or the other, and over the long term, it will probably look to wash out, or you can go 50-50. Yeah, read up on it. It's interesting, but hopefully that helps you understand what mechanically is happening, the difference between being exposed to both share market price movement and currencies movements versus just trying to be exposed to only the share price movements.
Any plans on adding financial advisors to your service options? Loving the platform, but wouldn't mind specific financial advice. Dean, I think this is a great one for you to answer.
It is. It's a really big problem. You know, financial advice and particularly financial planning plays a really big part. And so I'll step back and give some context here as to where do we see this. Kernel has such a spectrum of customers, people who are, you know, working hard, trying to save, build wealth, to first-time investors, to those who have got tens of millions of dollars. And everyone has different needs. But what's interesting is a lot of people still like to be able to speak to somebody about sort of the bigger picture of what they're trying to achieve in their life. And so we're trying to tackle that a little bit through things like building out our goals and the way that we're rebuilding our dashboard. But there is a real role for financial planners and having somebody independent that can help you make a decision. And typically those decisions will be sitting down and they're quite emotive. So it's quite easy to ask you a few questions and go, okay, how comfortable are you with ups and downs of the share market? How long are you investing for? And you can do that on Sorted. Sorted has some great tools, and that will help you to determine, should I be in more of a conservative versus a high growth fund? what that doesn't help you with is the bigger picture. And that is, okay, we've got some money now and we want to also think about our children and we're not sure what we want to do in retirement. And we've also received some inheritance now. How do we come up with a plan for where do we put all those different money? Should we pay down our mortgage and then invest? That's where a financial planner advisor can add a lot of value, because they're quite emotive, personal questions. And so we work with a lot of independent financial planners across the market. We do not pay commissions. We do not pay people for those services, and we don't do it in-house. But we can connect you either with independent advisors. So if any, we have people ask, we can recommend lists of people. Money Hub has a good source of independent planners. But we are definitely looking at how do we help people with an advisor, get oversight from the Kernel portfolio. So you can have somebody access and get a view of what you've got in Kernel and help you plan through that. So look, financial planning is a really big part, and context to why it's going to become bigger. There's about $1.6 trillion that is going to move between generations in New Zealand of wealth over the next sort of 15 odd years. That's a massive amount of money. Now, New Zealand, that's actually heavily tied up in property. So there's a whole lot of people out there who over the next decade or so, and I've been through this, you have those personal situations where you've lost a family member and you go, what do I actually do now? Do we sell the house? What do we do with this money? And so the intergenerational wealth transfer is a really complicated problem, and financial planners can play a key role. So love to chat to people on that. If you ever need access to some, like I said, Money Hub's a good start point as well. Think of these as professionals though. If you're not paying for that service, really question what you're getting, because that's probably more a sales channel rather than actually independent financial advice. Think of an independent financial planner like a doctor. You want to be paying for them. They're professional service. It's like anything. If you're not paying for it, you're the product. Caution what you're eating.
I want to know why it's a good idea to invest a large amount of money all at once. This is totally a personal thing. And so what I'd recommend you do is go over to our blog and look up in the search box. It's called Lump Sum. We have a great article outlining how or why you might invest a lump sum all at once. I'm not sure if you want to add anything, Dean.
Yeah, look, there's two lenses to this: lump sum versus dollar cost averaging. The statistics point to invest it all, and the reason being is that on average the market is going up. So the sooner you invest on average, the better off you're going to be over the long term. And it's still like a 60-40 type game though, in terms of I think some of the statistics we're seeing. You see various stats as to different markets. But broadly speaking, historically, it's been better to put it all in earlier. But that doesn't help you as an individual. And by that, it doesn't solve the emotional problem, which is great. I put it all in and then tomorrow it goes down. And then if you instantly have buyer's remorse and then you want to sell it, you're going to be in a really bad outcome. And so we see people of all spectrums and go, actually, if you are concerned about how you may emotionally react or what it's going to mean to you, dollar cost averaging is a really good idea, just simply to smooth it out and remove the emotional risk. Don't overthink and try to absolutely get perfection with timing the market or squeezing out every cent, because the bigger risk to your actual long-term wealth is the fact that you stuff it up and then you react because you pull it all out. That's more damage than the benefit of dollar cost averaging. So yeah, very much think about dollar cost averaging just to remove the emotional risk, because stepping back from all of this, the thing that's actually going to drive 90% of your wealth in retirement is not getting the perfect tax or the perfect fee or the perfect time. It is literally the habits that you have and sticking to your goals, being invested, contributing. The human emotion part, that is the thing that's actually going to drive most of your outcome. And so what we're trying to do with the platform is also really drive that and help you have confidence as investors and give you the tools to make sure that you can stick to that journey at all times through all the market ups and downs.
That's right. Here's Cameron McDonald. It's time in the market, not timing the market. A value we hold dear to our hearts here at Kernel. Is there anything else there that we want to cover?
There's been a lot that's been popping up. So yeah, maybe we've got a bit of time. I've still got a couple of moments. So quick fire now. If you've got any quick fire questions, jump them in now. If we haven't answered something, and we'll try and spit through them in a couple of minutes because it's hard to scroll through. But I mean, if you don't want to ask the question here, there's always our support team. You can fire off questions. I will do a shout out for our support team at the moment, our CS team. And you've got Alison, who's joined us recently, who's been fantastic, and Trisha, Tommy, and Johnny. Kat, who many of you will have known, has actually gone on mat leave now, which is fantastic. Our support team is here, but you guys have been, we've been growing pretty quickly. And so I want to call out, fully acknowledge that actually our response time, at times can be challenging, but we're jumping into that at the moment, and we are here. We are going to be responsive. So please do keep sending in those questions, those feedback. And if your ideas aren't coming through, ping Armin, because he'll pick it up for you.
Happy to hear them.
Some quick fire there. Provide historical unit prices for each fund. Man, I hear that one. We provide some price graphs, but yeah, not unit prices. We'll unpick that a little bit more. I'll chat to Armin and we'll come back to you on that one. Should I be milking the gains for my lump sum from time to time? Not more context, not advice. No. If you worry about large drop in portfolio value after lump sum investing, then you may also need to consider your portfolio asset allocation may be too risky. Exactly. Now, the counter to that, Alex, though, is that what's interesting with risk and selecting those profiles is you may answer a questionnaire on Sorted and it tells you that you're a high growth investor. We all think we may respond better to changes in the value of our portfolio until the moment it actually happens. Somebody tells you, oh, what happens if it falls through? I'll be okay with that. I'm investing for the long term. Slightly different on the day when like COVID hits and you see, oh my God, I've just lost $10,000. And those emotions become much more real at that point. So yeah, it's trying to find that balance. But again, that's where somebody to help guide you and keep you in check can really play a role. Any plan for more diversified US funds like Vanguard? We've got a pretty diversified suite now, and the way you can blend like the US 500 and World X, there's a lot of control there. Maybe we can solve that through helping you automate that, so you can set it to a strategy mix that you like, and then it can achieve that, but you're in control of it. Is the value displayed before or after tax in the Kernel funds in the dashboard? I'm pretty sure that will be showing that's before tax. So that's showing the unit price, and you'll be paying tax at the end of financial year. Can you explain the benefit of Smart Saver? Returns are going to be 1.8% in a day. Watch the space, I would say. The Smart Saver very much is still, look, we think about that as a great place for those emergency savings. If you want a little bit more and you don't mind a little bit of lockup for a few days, we've got our Cash Plus. But Smart Saver account is a great way to have something that's outside of your day-to-day bank that has an interest that you can move between things as you need. But again, Roadmap has plenty of ideas about what we want to do to help people with their savings.
Automated regular withdrawals for retirees. Absolutely not a silly question. We get this one a wee bit. I can't say it's on the near-term roadmap, but it's absolutely something that, yeah, we're listening to. So thank you for sharing.
I would say, again, like that withdrawal, we wrote a blog that's relevant for that around don't chase dividends, and actually regular withdrawals is a much better outcome. It's on our website. You can have a read about that if you're interested in dividends versus selling. Yeah. What do you think about the long-term capital gains in the New Zealand housing market? Are rental property owners better off in the market? Look, the big difference has been leverage, right? We all know that it's leverage in the property market. The 2-second final, because I'm getting the wrap up, and clearly we have a lot of questions, which I must say just thank you so much. It's great to see there's so much engagement. I want to talk about financial literacy in New Zealand. I think this is the big step change compared to 10 years ago. So thank you. Do keep reaching out, and you can email me. You can drop me on LinkedIn, find me. Love to chat. Love to get your ideas. The big step change, I think, with property that has changed the game is step back and think about what has actually happened for the past 40 or 50 years that's driven property. One, we had a share market crash and we had a bit of a Wild West stock market in New Zealand in the 1980s. Then we had the finance companies. We haven't really had, well-known or accessible financial markets. The ability to invest overseas, things like index funds, like Kernel's offering, didn't exist 10 years ago, 20 years ago. So people focused in on property. And the tailwinds behind that was basically you've had falling interest rates from about the late 1970s. And that falling interest rate has been a tailwind to anything that you've bought with leverage like housing. Another big factor is that you've had the shift from single income household to double income households. And so the shift from single income to double income, we're collectively all out in the workforce now. And now the loan to income ratio and the house to income ratio, they are stretched to the max. So these kind of levers that have supported property price growth, they are at their limits. There's no more trajectory to go. We can't really go that much lower with interest rates. we can't add more income into our household. We're at those leverages. So I think now that supply is sort of starting to outpace demand in New Zealand, I think the idea that property is just this guaranteed money-making machine, I think those days are over, and I think that's actually a good thing for New Zealand in the long run. So,
yeah, well said. I think we're going to call it there, team. Again, big thank you for everyone who's hung on to the end. We really appreciate it. Again, feedback, it's welcomed. If you haven't had your question answered today, I'm sorry. Please send it through to support. We'll come back to you on it. But yeah, again, thank you very much and have a great night.
Thanks, guys.